Are we looking at a stock caught in a falling trend that's just flashing massive sell signals? Or is this a strong buy that some are calling deeply undervalued? That is, well, that's kind of the multi-billion-dollar question we are tearing into today.
Yeah, and it's a question with a lot of noise around it, right?
Oh, so much noise. We're looking at AMC Entertainment Holdings today.
Yeah.
AMC.
Hmm.
And we have a massive stack of sources on the table. We've got their fiscal 2025 financial reports, a ton of technical market data, and the latest analyst outlooks, too.
Right, which we really need to dig into.
Definitely. But hey, before we jump into the raw data, if you are watching this, make sure to like the video, subscribe to our YouTube channel, and honestly, it's compulsory to leave us a comment with your feedback. We really want to hear your take on this because people are incredibly divided.
They absolutely are. It's a battleground. And our mission for this deep dive is to essentially strip away all the social media hype.
Yeah.
Get out of the echo chambers. We just want to look at the raw data and debate whether AMC is a genuine recovery play or, and this is the big fear, a really dangerous value trap for retail traders.
Yeah, a trap is exactly what a lot of people are worried about.
Exactly. And just to set the ground rules right up front for everyone listening, this is strictly an educational exploration. We're looking at the source material, the natural market debate,
Yeah.
strictly no financial advice here.
Right, absolutely. No financial advice. So let's get right into the roller coaster because to understand if the stock is a buy or a trap, we kind of first have to look at the massive disconnect between its recent wild price swings and, well, its actual bank account.
The receipts, basically.
Yeah, the receipts. Because the price action lately is just giving people whiplash. AMC recently closed at $1.86.
Right.
Which, sounds tiny, but that was a 15.53% leap in a single session.
Yeah. That's a huge move for one day.
And if you pan out to the last 30 days, it's up a staggering 89.7%. When retail traders see a 90% surge in a month, I mean, the FOMO, the fear of missing, it's real. People just pile in.
They do. They absolutely do. But we really need to quickly zoom out here because despite this, short-term bullish explosion, if you look at the trailing 12 months, the stock is still down about 33.1%.
Wow. Still down 33% after a 90% rally.
Exactly. It's currently trapped in this 52-week range of 93 cents on the low end to $4.08 on the high end, so that near 90% rally.
Yeah.
It feels massive, but it's really just the stock trying to claw its way back up from this massive cliff it fell off over the last year.
Okay, so it's all relative. It's like people anchor to that recent jump from 90 cents to $1.86 and think it's a rocket ship. They totally forget it was way higher just a year ago.
Right, the psychology of anchoring is huge here.
So to understand why it fell off that cliff in the first place, we have to open up the fiscal 2025 financials. And I've got the income statement right here. The numbers are, well, they're kind of sobering.
Very sobering. Yeah.
Total revenue sits at $4.85 billion, which is down 1.38% year over year. But the real issue is the net loss, negative $632.4 million.
Yeah, over $500 million in net loss.
Right, with an EPS earnings per share of negative $1.34. But here's the weird part. The EBITDA is actually positive. It's sitting at $341.9 million.
And that right there, that's the crux of their whole financial reality.
Can you explain that? Because having a positive EBITDA but a massive net loss seems, I don't know, contradictory.
It does seem that way, but it's actually really common in heavily indebted companies. So EBITDA is earnings before interest, taxes, depreciation, and amortization. It basically means the core business, selling movie tickets, selling popcorn, that part actually works.
Okay, so the physical theaters are profitable.
Exactly. The physical locations generated roughly $342 million in positive EBITDA. But the moment you drop below that line and you have to pay the massive interest on their corporate debt,
the debt.
right, you pay the interest, you pay taxes, depreciation, suddenly that operating profit is just wiped out. It flips into a $632 million net loss.
Wow. Okay, so let me put this in everyday terms so I can wrap my head around it. If AMC was a person, it's like they make $48,000 a year at their job, but they are drowning in almost $100,000 of credit card debt.
That's actually a really good analogy.
Right, and their bank account is just draining by the month because the interest payments are so huge. Which brings us to the balance sheet.
The balance sheet is where it gets really scary.
Yeah. Total assets are $8.02 billion. But total liabilities are a crushing $9.91 billion, leaving shareholder equity deeply negative at minus $1.8 $9 billion. I mean, how on earth does a company function with negative equity like that?
Well, they function by burning through whatever cash they have left. And you can see that reality in the cash flow metrics. Operating cash flow is negative $119.8 million.
Ouch.
And free cash flow is negative $365.9 million. They ended the period with about $477.3 million in cash.
Wait, so they're burning $365 million in free cash flow a year, and they only have $477 million left in the bank.
Exactly. You don't need a finance degree to see the problem there. The runway is incredibly short. Without a massive turnaround, they're going to hit a wall.
Okay, so if the fundamentals are screaming distress like this, how on earth is the stock up almost 90% in a month? Like, the chart has completely decoupled from the bank account.
It has, and that's why we have to shift gears and look behind the curtain at the technical signals and the market mechanics. Because right now, the fundamentals aren't driving the daily price action.
It's just momentum, right?
Pure momentum and algorithmic trading. So let's look at the technical analysis. AMC is trading below its 200-day simple moving average, or SMA.
Which means the long-term trend is still pretty bearish.
Exactly. But it recently crossed above its 50-day SMA.
Ah, the 50-day cross. That's a huge trigger for, like, trading bots, isn't it?
Massive. When a beaten-down stock crosses that line, it triggers automated buying from high-frequency algorithms. And then you add the RSI, the Relative Strength Index, into the mix. It was sitting at 33.25.
Which is basically right on the edge of oversold territory, right?
Right. It means the heavy selling pressure had essentially exhausted itself. So when selling pauses, even a little bit of algorithmic buying can cause a huge spike. But the most interesting thing in the data was a MACD fast bullish crossover.
Okay, I have to jump in here. Because I see people online point to a MACD crossover like it's a guaranteed lottery ticket.
Oh, I know. It's dangerous.
Right. So looking at this MACD crossover, is this an actual legitimate trend reversal, or is this just a classic dead cat bounce?
Well, let's look at the context. The MCD is just a momentum indicator. It doesn't know about the $9.9 billion in bet. A dead cat bounce happens when a stock is heavily oversold, the sellers step back, and shorts take some profit, causing a mechanical bounce.
So it's not real sustained demand?
Not fundamentally, no. And if we look at support, resistance, and order flow, it paints a clearer picture. There's immediate resistance at $1.94. Support is lower, between $1.64 and $1.45. But the volume is what's truly crazy. 88.2 million shares traded.
88 million shares. Okay, who is buying that many shares of a company with negative equity? Is Wall Street piling in?
Definitely not. Let's look at the analyst consensus. It's officially a hold.
A hold?
Yeah, 25% say strong buyer buy, 50% say hold, and 25% say strong sell. The average target is $2.02. B. Riley recently bumped theirs to $2 flat.
But a hold on a heavily indebted penny stock feels like a polite way of saying, don't touch this.
Pretty much. And if you look at the insiders, the executives running the company, they aren't buying either. February 2026 data shows zero significant open market buying from insiders.
Wait, zero?
Zero. There were 18 transactions, but they were all just for stock awards and tax dispositions. No executives are reaching into their own wallets to buy shares at $1.86.
Wow. So if institutions aren't buying and insiders aren't buying, it's just retail traders driving the bus.
Exactly. Retail traders and momentum algorithms.
Man. So we've got these really bleak financials and this highly volatile technical setup driven by retail FOMO. We have to kind of synthesize these two things. This is the great debate. Is this stock actually an undervalued gem waiting for a macro turnaround, or are retail traders just being lured into a massive value trap?
Well, let's break down the valuation claims first. Some standard models put fair value at $1.72.
Okay, so at $1.86, it's actually overvalued right now.
Right, by about 8%. But there are contrarian models. Investing Pro, for example, previously flagged it as significantly undervalued. But that was before this recent 68% leg of the surge.
Got it. Okay, I want to play devil's advocate for a second. Let's outline the bull case, the best case recovery scenario, because there's some silver linings in the sources.
Sure, let's hear them.
First, they're projecting improving margins like a 12% expansion by 2027. And the 2026 film slate is supposed to be incredibly strong. The sources specifically highlighted the movie Project Hail Mary.
Right, the product is improving.
Yeah, and we just saw record-setting box office revenue from the 2026 Easter weekend. People are actually going back to the movies. But maybe the biggest thing for the bulls, their subsidiary, Odeon Finco PLC, just secured a $425 million new term loan.
They did, yeah.
Doesn't that extend their maturities and basically take immediate bankruptcy risk off the table?
It does take immediate short-term bankruptcy off the table. They essentially bought themselves time. But we have to pivot to the bear case here, the worst case continuation, lower.
Okay, hit me.
Buying time comes at a huge cost. When you take out a $425 million loan in this environment to roll over old debt, you are paying significantly higher interest rates.
Which just makes that cash burn we talked about even worse.
Exactly. It accelerates the burn. The bears look at that and say, look, you still have $9.9 billion in liabilities. You still have persistent net losses. And even with a good Easter weekend, the broad multi-year trend is declining overall theater attendance. Plus, theaters have incredibly high fixed costs. Rent, utilities, staff you pay, that whether the theater is full or empty.
Yeah, that makes sense. So for you, the retail trader listening to this, the downside risks seem huge. We're looking at a market sentiment currently driven by short-term greed and speculation because of that 89% monthly rally.
It is entirely speculation right now.
People see a cheap stock and think, oh, if it just goes back to $5, I'll make a fortune. Completely ignoring that long-term institutional sentiment remains highly cautious. Why do retail traders get trapped here so often?
They get trapped because of the volatility. Volatility is the real danger. When stock is trading under $2, a 20-cent drop isn't a small dip. It's a massive percentage loss of your capital. The algorithms that are buying today will flip to sell in a microsecond if the momentum breaks.
Right. The bots don't have diamond hands.
No, they don't. And when the bots sell, the liquidity dries up, and retail is left holding the bag on a company with massive negative equity.
Man, that's brutal. So let's wrap this up with our outlook. Short-term versus long-term.
Sure. Synthesizing the core takeaway here.
Yeah.
In the short term, we're talking days or weeks. You have to expect continued violent volatility. Retail is going to react to every piece of box office news, every debt maneuvering rumor.
It's just going to chop around aggressively.
Exactly. But in the medium to long term, survival is entirely dependent on sustained box office recovery. Not just one good weekend, sustained recovery. And somehow, management has to manage that massive $9.9 billion debt without completely diluting shareholders into nothing.
Which is a monumental task. Well, this has been an incredibly eye-opening deep dive. If you're still watching, please remember to like, subscribe, and drop your feedback in the comments. We read them all.
Absolutely.
And I want to leave you with one final provocative thought to chew on. If AMC relies completely on unpredictable box office hits to simply tread water on its billions in debt, at what point do we stop calling it an entertainment stock and start calling it a lottery ticket? Think about that before your next trade.